This evening, we have financial advisor extraordinaire, my friend Jay Joseph.
Good evening, Kim. Thank you for those kind words. Not sure where you got them from, but I appreciate that. Good evening, everyone. I appreciate it, guys. I know your time that you're taking today is the most valuable thing that you have. And I thank you for investing that with me. So we want to make sure that you get a return on that. All right, so as Kim mentioned, my name is Jay Joseph. I am a licensed financial advisor. I've been licensed since 2007. And as a licensed financial advisor, I'm not the orthodox financial advisor. I'm more unorthodox. My goal is to get us to wealth and wealth at an exponential level. So with that, let me tell you a little bit more about me. I got to a point where I stopped working hard and I started working smart. And I got to a point to understand what money is, how money works, and how to make this thing work for me. But not about me, but what can I do for clients and what I do for individuals? I teach people how to imagine, instruct, and invest into multiple streams of income to build wealth in order to achieve that thing that we all want called financial independence. And what is that? Living life on your own terms, getting to wake up to determine what job I'm going to work for or what job I may want to start. But the beautiful part about that is you can do that anywhere in the world. So when I take that into consideration, we were taught to go to school, get a good job, and of course, put money away in our employer and sponsor retirement plan, and then we're going to achieve our financial goals. Look around. Look at all the people that came before you. How many people have followed that same path and accomplished that goal, or at least accomplished the lifestyle that you want? Not many. I think one of the most problems is that most people, they look to retire on average the age of 65, but we shouldn't retire. We don't retire from something, we retire to something. And that's what I want to help people understand. Right now, I'm not even 40 and I'm technically retired. I no longer have to work for corporate America. I was able to fire my boss and become my own boss. And that's my goal and what I want to do for everyone else. But it took time and it took investments in order to do so. So that's what we really want to talk about tonight is investments. That word is thrown around and it's used a lot. Now, when we look at investments is simply, it's where you're going to put your time, your resource, or your talents into something, expecting some kind of rate of return, right? Now, you can also, there's three things that you can invest: your time, your knowledge, and also your money, i.e. your resources. But those are also three things that one can leverage. So when I take that into consideration, you have to put your time, your money, or your knowledge into places that's going to get you the most and the highest rate of return. In my journey, one of the best things that I've invested in was myself. Hands down, that's it. It's the best investment. That investment pays residuals to me to today. And most times we're looking for other people, other things to invest our money into, which are our biggest resource is going to be ourselves. Now, when people say invest in yourself, what does that actually mean? That's education. Not necessarily in the school sense, but that's more so reading books. Someone said before, if you want to hide something from people, and certain people, you put it in a book. A lot of information are in books. If you really want to save your time, which is what, yet again, our most valuable resource. I can lose $1, I can lose a cell phone, I can lose a car, I can lose a house. The best thing is I can go get all those things back, but I can't get back when I was in my 20s. So we want to make sure that we take heed and know that time is our most valuable resource. So how do you save yourself time? You invest in mentorship. You invest someone that's been there doing that and doing something that you've already done before. What does that do? That saves you time, and it also gives you their knowledge, their experiences of what works and what didn't work to expedite your journey. Over the last few years, let's say over the last two to 3 years, I've invested more than about $25,000 in this thing called trading in the stock market. It's $25,000 I invested in myself, right? Over the last few years. But guess what? I make $25,000 a week now because of what? The investments that I've made. That saved me time, that saved me money. Just last week, I just made another $25,000 in my investment in myself to continue to grow. So we got to make sure that we're investing in ourselves. We can do that by how? Investing in books, materials, and also mentorship. A lot of us want these $1 million ideals, these $1 million plans, the $1 million gems for free. Unfortunately, normally it doesn't work like that. All right. So now, once you have invested in yourself, that's going to do what? That's going to produce some kind of income. And 9 times out of 10, it's going to be something we call earned income. Earned income is where you have to trade your time for money. We want to get to a point where we have something semi-passive, where it takes less of our time than the regular 9 to 5, or something that's fully passive. And that does what? They generate cash flow. The name of the game, guys, is cash flow. That's having money coming in residually. Now, when I invest in cash flow, I look for things that's going to generate me income where I don't have to spend a whole bunch of time in doing so. When I invest in those things like cash flow, I use OPM, other people's money, in order to invest in cash flow assets. And let me give you an example. The first investment that I invested into when it comes to my cash flow journey was vending machines. So what I did is I had money in my employer-sponsored retirement plan. Me personally, what I would recommend for myself if I was still working for a company, I will contribute to that retirement plan, whether it's a 401k, a 403b, a 401a, a thrift savings plan. I will put in the amount that my actual employer is matching. Understanding and knowing what I know now, I won't put a dime more into that particular account. So I did that. I made those contributions. I invested into that retirement plan. So I built up cash, and then I invested that money into what we call mutual funds. Just to give a little bit of breakdown, a mutual fund, it's a financial term, which is a conglomerate of different stocks, companies such as Apple, Microsoft, Google. It varies. And a particular mutual fund that's actually managed by a team or an individual, as far as a manager, that manages these funds to try to get the highest rate of return for an individual. Me personally, understanding what I know now, I don't invest in mutual funds. I would never invest into another mutual fund because my level of knowledge has educated me to where if I want to invest in anything, it's going to be an exchange traded fund. But even above that, I invest in individual stocks as far as via the stock market, because I understand fundamentally and also technically what companies I should be putting my money into to invest. But unfortunately, our employer-sponsored plans, they limit us to only mutual funds in that particular account. So we have to work with what we have. But even with that, I still averaged a rate of return. Typically, you may see anywhere from 7 to 10%. I averaged that 7 to 10% on money that I contribute, that I invest into that retirement plan. Then I started doing further research. I realized that my employer-sponsored plan offered what we call a loan option. So I was able to borrow, aka leverage, money that I have inside of that retirement plan. So I borrowed that money from the money that I worked hard and I accumulated, which is one way of using leverage. And then I did I acquired what we call a tangible asset. That tangible asset was vending machines. So now what did this vending machine do for me? It started producing me cash flow almost immediately, because these were existing vending machines in existing locations. So with these particular vending machines, now I have to change out these vending machines some were once a week, some were every other week. So now I'm not trading an hour for $1 anymore. Now I can go to these vending machines once every week or every 2 weeks, and it start producing me cash flow now, and I use money that I borrowed from my retirement plan to do so. Now, the ultimate way to invest in cash flowing assets right now in today's age is using credit, OPM, other people's money. We have to make sure our credit is ideal. We also have to make sure that we have people in our circle where if we need to come up with money to invest, that we can call upon them for different opportunities. But when you use other people's money, you generate cash flow. The more cash flow that comes in, now that can eventually supplement your current income from your employer, allowing you to be work location independent. Right now, I'm not even in the US right now, but I can still create no matter where I am in the world, because I have I have multiple streams of income coming in, most of which are passive. So when we invest, number one, you have to invest in yourself. Number two, we have to invest into cash flowing assets first. Once we have cash flow coming in, then we can start looking at tangible or intangible assets that produce us what we call a gain. What is a gain? Something that appreciates over time. Some investments may produce income and or pay you cash flow, such as certain stocks. An example I can give you guys is, let's look at a company called Verizon. Verizon is a telecommunication company, and they have the ability to go up in price. I buy it at one price, and it has the ability to appreciate. Not only that, it does pay out something we call a dividend every quarter. So not only do I have the benefit of getting that cash flow that's coming in, now it has the ability to appreciate. So some assets does both. but you always want to invest in cash flowing assets first. The worst thing you can ever be, you might have heard before, is let's say asset poor, or better yet, home poor, a house poor. You put all your money into an asset and you get no return out of that. That's like, I'm gonna go buy gold. Is gold a bad asset? Depends on your financial situation at that time. Gold can be a great tangible asset to hedge against this thing, what we call inflation, when prices rise around us. But gold is going to pay you how much income? Zero. You're only going to get money or return from gold when you sell it. So that's an asset that is only meant for appreciation. We want to buy assets that produce cash flow first. Then we go to assets that actually produce a capital gain. Now, when you invest, you have to also consider your risk tolerance. Kim made a great point. We're not taking too much risk. I coined it as you have to be able to afford to invest. Because if you can't afford to invest, then you shouldn't be investing. A lot of people try to invest what I call your emergency funds, which are simply funds I need to live off immediately in case something were to come up unexpectedly. That's money that we do not invest. That money is there for the short term. Once we get into a strong financial situation, have a strong foundation, then one can use leverage, lines of credit, and/or credit cards to access for emergencies. But until we get the financial literacy that we need to have cash set aside. The reason why I don't like too much of cash, because cash sits inside a checking, savings account, money market account, or a certificate of depreciation. A certificate of deposit, and it does not earn much or any kind of return. Although it's considered an investment, but it's not earning much of a return. Money that's sitting stagnant into such vehicles, it does what? It loses what we call its purchasing power. Simply means this shirt that I got on, the watch that I'm wearing, this watch cost less 5 years ago than it did today. A loaf of bread is a great example. Some of us may recall when a loaf of bread was $1. I don't want to date anyone, but you recall when a loaf of bread was $1 a loaf. That same bread, made with the same ingredients, the same packaging, tastes the same, is now about $3 to $4 a loaf. What is that? That's called inflation. That's where consumer goods increase in value, and not necessarily value, just increase in price. Value and price of something is two different things, but it increases in price. And this price that it increases in is something that we have to pay. And if our money, and on average, inflation increases about 3% on average a year. Ask yourself, is your checking, savings, money market, certificate of depreciation, certificate of deposit, does it pay 3% or more? So simply means you got all that money sitting in the bank and it's losing value every single day, every single year. So when you go to pull it out to go buy something, to consume something, now you are buying less of which because everything has went up in value or price, but not your money. So we have to do we have to really create a plan where we got our money working for us, at least the majority of it. But specifically when we invest, you don't want to invest the money you're going to need to supplement your income immediately for emergencies. That money needs to be set aside. Now, once you have that built up and that's established, and that just coming up with that, having a strong financial foundation is something that Kimberly definitely helps people out with through the Debt Detox program that she has. She helps individuals build a strong financial foundation. That strong financial foundation, one of those pillars is having emergency savings. So once you have that emergency savings, now we can transition to every dime after that needs to be invested and working for you. You go to work every day, you work hard, so why isn't your money? That's just like you got kids, 35 years old, staying in your household, they're not working, but they're running up the electricity bill, the water bill, and everything else, and you're paying for it. Your money needs to be working for you, and you should always be working for your money. The word tells us that money should run after us, and it should be an overflow. We're going to work and we're going to grind and hustle for it every single day. So it's just a lack of knowledge, and a lot of this information was not told to us, explained to us, and a lot of this, the terminology can be quite complex in the financial industry. And this is why I want to be a pillar to be able to help individuals achieve this thing called financial independence, not be rich, because athletes, NBA players, they are rich, at least at one point in time, if they don't stay rich per se. NFL players, those are rich as well. Interesting stats, 60% of NBA players, 84% of NFL players 5 years after retiring from their high-paying job. Yes, their high-paying job, that's all it is. They have a high-paying job that brought them in riches, but after 5 years of being retired and no longer generating the high income, guess what? They're bankrupt. That's why I want to be wealthy. Now, what is wealth? It's an accumulation of assets. These assets can pay a cash flow and or provide a capital gain. Wealth is literally how long can I pay my bills and expenses every single month without getting out of bed? Some of us call that mailbox money. Having one stream of income is too close to having zero. That is a dangerous game that we're playing, but yet that's what we were taught. I want to help change it. A lot of things we have to unlearn, to learn, to relearn. So it comes to a point where we really got to understand what money is, how money works, and how to make this thing work for you. And this is the journey that I've been on, all my life, because I always wanted to be this wealthy African-American male that did not have to entertain. Bless those that have those talents that God gave to entertain. Use those to build wealth. I wasn't blessed with all those, one little bit, I play ball, but me making it to the league, the probability of that was low. So I pursued this thing, and I really wanted to show people that as an African-American male, especially as a younger African-American male, that you can get paid for what you know versus only what you do in the physical aspect. And we don't have to do things illegally to build this thing called wealth. I have multiple streams of income. As I talk to you guys, I make money. And I know Kim did a job of making this fictitious bio about me. It sounded good, but one thing was a little outdated. She said that I left the job because it's a company that I was working for did not serve my target audience. I was working with people that had money. That's not my target audience. We came to inroads. I had to fire my boss because the people that I know that needed me are the young J. Josephs. When I was in my teens, looking for a way to build wealth, to be wealthy, I didn't know what a financial advisor was, and yet alone a Black one at that. So now I had to get to a point where I had to go on this journey to really figure out what this money thing was. And I did that. And now I'll get to a point where I left that 6-figure job for making 6 figures in 12 months, 52 weeks. A lot of people say that that's the goal, to make 6 figures a year. I made that in a month now, after I made a conscious decision to pursue my dreams, my purpose, to continue to learn, to invest in myself. And now I got got to a point where I have now financial independence now. Now I don't worry about paying bills and expenses every single month. Now that's less worry and stress on my behalf. Now I can focus more on my health. Now, God forbid, I just had a family emergency and one of my relatives had surgery, and I was able to pay a couple grand for what they needed. And then I can be there with my presence. Sometimes your presence is more, it means more than your present. And I can do that because I have this thing called time freedom. A lot of us strive for what we call money freedom, which a surgeon, they have money freedom. If they're making a couple $100,000 a year, they balling in our terminology. They winning. They're securing the bags. But guess what? Let them not be in the operating room. Let them not work 50, 60, 70 hours a week. They're not making the money that they're making anymore. Me, I can make that money from jacuzzi here, another state, another country, because I have money freedom and time freedom. So that's why I'm on this journey to really teach people, how to imagine, instruct, and also invest in multiple streams of income. It's all about the cash flow. That's what the multiple streams of income is going to do. That's going to allow us to build wealth. Building wealth is now acquiring those assets. And then that allows us to live life on our own terms. There's more than one way to get there. You can literally use your intellectual property that you've acquired on these jobs and then invest in yourself, and then just teach people what you do. That's one thing that I do. I teach people how to invest and trade in the stock market. That's something that I do myself, and I don't have to do that because the level I'm at now, I'm all right financially. I'm good financially. But now I give back and I teach others how to do the same thing. So I learned something, and then I'm able to monetize my intellectual property. So that's why the best investment you can make is in yourself. Next of which, in yourself, that also includes your credit. Guys, credit is so key. Credit, i.e. leverage other people's money, is one of the main ways I got to where I got to. It is amazing the things that you can do. And let me give you guys a play. All right, this particular play here, I started off with an unsecured credit card. This unsecured credit card, I started off with $375. because my credit wasn't the strongest. Over the years, which 1 or 2 years, I built my credit card up by giving them a call every 3 to 6 months. Let's say about every 4 months, asking for a credit card increase. Do that. You will not regret it. Because once you get there, then I can show you what to do with that. But then I got that credit card up to $50,000, right? So understanding that, starting with the unsecured credit card, and my credit card is not up to par, getting those balances increased. And then guess what I asked for? I asked for the max every time. Don't tell no one you're trying to get credit for business. You're not gonna get that credit. All right, that's the gem. Hope you guys caught what I put down. Next, I got my unsecured balance on my credit card up to $50,000 with this bank. Perfect. Now let's fast forward. Your net worth determines your net worth. All right. So the people that you have in your circle, I had a particular client. One morning, shot me a text. Hey Jay, I got an opportunity. You get 20% return on your money. Tell me more. So what did I do? I vetted this investment opportunity. So what are you going to have to do? You're going to have to create a system on how you look at investments, because based off your current situation, you might not need cash flow right now. I can never say I never need cash flow. You never have too much, but cash flow might not be your main goal at the moment. Maybe it's appreciation. You have a good opportunity for appreciation, but we have to understand where you are and to determine how to get to where you're trying to get to. So with this particular play, he mentioned 20%. So I vetted this deal. Okay. And then what I did, I understood my worst case and my best case scenario. Then he told me the investment is $35,000. I said, great, $35,000. Start doing the numbers. My credit card, now that I have great credit now, my interest rate on that credit card is let's say it was 10% for the year. $35,000 at 10% of the year is $3,500. That is the cost to me for using other people's money. But wait, didn't he say I can get 20% return on my money? Sometimes we look at the cost and not the rate of return, because we're not thinking like a wealthy person. We're not thinking like an investor. We're thinking as a consumer. I would get 20% all day and have to pay 10%. That means I just made an infinite rate of return on my money, because I didn't use my money. I used somebody else, and I made 10% on somebody else's money. This is how we have to think. So he said 20% was my rate of return. I said, great, 20% on 35,000 is what? $7,000. So I made $7,000, right? Using somebody else's money. So what did I do? I went to my bank and I said, bank, here's my credit card. Move this $35,000 to my checking account. It was there the next day. And guess what? The investment was for 2 months. 2 months of interest was only about $400 roughly. So I had to pay $400, but I made $7,000. That means I had a profit of about $6,600 using somebody else's money. The power of having leverage, OPM, using other people's money, and then having a network. Because your network, yet again, determines your net worth. If you're not around people that these opportunities don't come up, then these opportunities won't present themselves for you. But you have to be prepared for opportunities like that. And this is why you need to have the credit, the cash flow. And then we start investing into long-term assets. A lot of times when we hear investing, people want to put their money into something what we call buy and hold strategy, where I'm going to buy these things and I'm going to hold on to them long-term, and I pray that they'll be up when it's time for me to need them. That's not how we invest. That may have been in the agriculture age. Things has drastically changed. You know, when we hear something called the Great Depression that happened in the 30s, the stock market people got crushed in these scenarios. And to hark back on this structure about mutual funds just a little bit more, because that's what most people are taught to put their money into. As mentioned before, guys, I won't, and I no longer will buy or recommend mutual funds. Mutual funds, just to break them down a little bit, you have a fund manager or managers that manages these funds, these assets for you, right? Interesting stat, 90+% of mutual funds don't outperform the overall index. When I say the index, that's the S&P 500, the 500 largest companies in the US. 90+% of mutual funds don't outperform that, but yet we're putting our money into mutual funds. Let's go a little deeper. One of the 4 wealthy rollers is going to be And you can go to my website, jaysmoneyseekers.com, and you can download a free guide, what I call the Wealth Eroders, and you'll know more what I'm talking about. But one of the things is going to be fees, what we're paying for things. People are paying the cash checks, fees add up. Okay, you pay $8, great. I get paid twice a month. All right, that's $16. Now for the year, that's almost $200 I just paid in fees. $200 compounded over time can be a lot of money. So the fees associated with that is called the internal expense fee or the expense ratio. That's money that they charge you, whether you make money or lose money that year. They make money regardless. Yet again, 90+% don't even outperform the S&P 500 or the Dow Jones Industrial Average or even the NASDAQ. These are the three major indices when we're looking at the stock market. This is the information that we don't know. This is the information I want to be able to get out to individuals, because you don't want your good to be evil spoken of. You don't want to invest unprudently because you don't know it and you perish from lack of knowledge. So this is why, Kim has me on here. This is why Kim has the Debt Detox, to bring awareness to financial literacy, to really help people get to where they're trying to get to. And a lot of times people don't even know where they want to get to. And if I tell someone, hey, we're going on a trip, and they start packing bikinis, sunscreen, shades, to find out we're going to Denver and we're going skiing in the snow, they didn't know the destination. So they can properly prepare today in order to get to the appropriate destination, to be prepared for the destination we're going to. So I say it's vital. Understand what your why is. Understand where you're trying to get to. If we really want to just take it to the next level, think about what you want your eulogy to read. Think about that. Once you understand that, then you know every step you need to make today in order to achieve that goal there. And then once we get there, that's where we start investing. Now we're investing in ourselves. Now we're investing in the cash flow investments. Now we're investing in those assets that can appreciate. And then now we're going to eventually get to this place called financial independence. And if we want to expedite that journey, we can help. That's what we do. We show people how to create these multiple streams of income. We give them the financial education. We help them start from a solid financial foundation in order to get to where they get to. That's my spiel on investments. We can keep going every single day, but my goal is to answer questions that you guys may have, because a lot of times we don't have a resource, someone we can go to that's i.e. not capping, or don't have the experience, or don't have a lifestyle that we want to be at. Like, I left the state that I'm in, and I'm not going back to the state probably in another month or so. And I'm traveling to 3 countries and 2 other states. That's my lifestyle. And my passive streams of income pays for that. My trading pays for that. And I can do that with anywhere in the world because I've achieved this thing of financial independence. But then we don't have to deal with individuals that, unfortunately, that's how a lot of the industry, not everyone, but a lot of the industry is like that. We want to sell you high-priced products to get a high commission, but it might not be best for your situation. A lot of us want to invest the money for you, i.e. assets under management, but not teach you how to invest yourself. Because if the market averages on average 8 to 10% a year, 90+% of the mutual funds don't outperform the market. That's 8 to 10% a year. That's not bad. That's better than zero. That keeps up and exceeds inflation. But guess what? I can make that in a day. I'm definitely making that in a week. Hands down, that's happening in a month. So what? I just expedited my way to wealth by what I know and investing in myself. But not only that, applied knowledge is power. Not knowledge, applied knowledge is power.